Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, global markets reporter at NASDAQ. Joining us for this segment, we have Chris Englebert, founding partner and chief investment officer at Englebert Financial Advisors. Chris, it's great to see you as always, and I'm excited to tackle this topic. We're going to talk about debt, right? You and I talk about, financial planning, estate planning. These are all tough topics to tackle. And why should retail investors need to focus and manage their debt? I feel like we talk about making money so much, but not focusing on debt.
Yeah, you're right, Jill. It's one of those topics that, financial professionals, we're sitting there all the time. Hey, the stock market's doing this, the bond market's doing that. Here's your portfolio, your 401k, your IRA, et cetera. But we never really talk about the debt side of the balance sheet for people. And I think it's a little scary what's happening. I mean, we've been in an era of low interest rates now for a couple of years. People are refinancing their homes. One of the kind of the alarming trends, is people going out and buying, an additional beach property or something like that. And they're kind of levering up at a point in their lives that it may not make sense to do that. And so I've had a couple of situations in the last, 6 to 9 months where, clients have come to me and they're like, hey, we're buying this. What do you think? I'm like, well, that's great, but didn't you tell me you were retiring in 2 or 3 years? So I don't think, and unfortunately, one of the things we do see is that when people lever up, they forget that, I owe $500,000 or $750,000. What would happen if I died or my spouse died? How would we pay that off? And so, I think it's a hard conversation that a lot of RIAs and a lot of clients kind of are avoiding right now.
Right. And Chris, it's so interesting. I have also heard of a lot of people starting to lever up, and especially with the money that they've made in the real estate market over the past 18 months. But, we went through this in 2008 and 2009, where, you saw people who didn't have the income to own 2 homes and a spec house in Naples, Florida. So it is a bit concerning. And with that said, how should RIAs approach their clients when they're talking about debt?
Well, I think we have to be candid with people. I'm trying to have these hard conversations now. And of course, we all understand we're in an inflationary environment. 2 things that do really well in inflation are stocks and real estate. And so people seem to want to shift their portfolios to be more focused on real estate. But they're taking out debt. And I'll say things like, hey, you've made a lot of gains in your portfolio. If it's a taxable individual portfolio, let's take some of those gains and try to de-lever or pay down that mortgage. But if you have a large chunk of money in a 401k, you almost have to do the same thing. Now, obviously, you can't take the money out of your 401k, but hey, what would be wrong if somebody had a really good return the last couple of years in their 401k just to set aside 200, 250,000 and kind of lock it down in very safe investment strategies, so that if something would happen where you would lose your job or death of a spouse, unfortunately, you'd be able to have some cushion that you wouldn't have to rely on and a way to pay down this debt. Because again, this is a phenomena that I haven't seen in a long time. And it's something that we're trying to make people aware of.
All right, Chris, let's take a look at our charts. So we'll start with the S&P 500, and it really is quite incredible. We're still sitting near all-time highs. It's like the market has really ignored a lot of the outliers that are out there.
Yeah, exactly. And the old adage, sell in May, did not work. This summer, we continue to make multiple new all-time highs. And if the market continues on the pace that it's doing, even if it started trading sideways, this would be 2017 all over again, where you had extremely low volatility. The market just continued to, march straight up. Now, I think it's interesting because we're seeing a lot of media, talk about how September, traditionally is one of the poorest months out there. And I always have said to clients, if everybody's talking about it, it may not happen. So we'll see what happens for the rest of the month of September. But so far, the S&P 500 has been holding very steady.
And let's talk about the NASDAQ 100 here. Clearly, the FANG stocks have really lended to not even the NASDAQ 100, but the S&P 500 as well, because of the concentration in tech that we see these days. It really is contingent on the movement that we're seeing in these large cap, mega cap tech stocks.
Yeah, this is so, I don't know how much you're following the US Open, but on the women's side, there's some new young talent out there from Canada and from Great Britain, and these young women are battling back and forth in a ferocious way. That's what's going on with the NASDAQ right now. I mean, you've got the old stalwarts, trying to continue to push the, NASDAQ higher, but all of a sudden they, start to lag and value starts coming back in, and then boom, growth comes back again. So we'll see. I do believe that, there's some gains that are being digested right now. I would not count the NASDAQ out between now and the end of the year. And in that horse race, we don't have the chart up, but the Dow Jones Industrial Average is now starting to lag both the S&P and the NASDAQ.
And Russell 2000, always trying to join the party, but it just can't consistently get there.
Yeah, I think there was such a huge, big move going on at the beginning of the year because obviously, lockdowns had run their course. And so the Russell, I was very impressed. I said, with the Russell broadening out the entire market rally, this is good. But now we're running into a trading range market. And I'm wondering if the trading range market in the Russell is pretending what's going to happen in the S&P and the NASDAQ probably in 2022, where you get these, resistance bands on the upper side and also on the downside. It's not a bad thing. I mean, one way you consolidate big gains is to trade sideways. And, I'm looking for 2022 could end up being the year that the Russell, continues its rally that started so strongly in 2021.
All right, let's move along to oil here, trying to get some sort of a rally going.
Yeah, and I'm a big oil bull. I wouldn't count it out. I mean, it's breaking through an intermediate trend line right now. Even with all the stuff that's going on down in Louisiana and the hub of energy in the United States, again, oil is literally the currency of the reopening of the global markets, and I think the surprise is still on the upside for oil this year.
All right, let's wrap it up with the 10-year Treasury. And of course, this has been making a number of headlines as we think about inflation and interest rates and what the bond market is trying to telegraph about that.
Yeah, exactly. And I try to tell my clients, watch the 10-year Treasury all the time. When rates start to go up, that means inflation's coming back and, the economy's starting to heat up. It'll be very interesting to see how the rest of the year plays out into 2022, because we've had such a tremendous amount of growth in the short term, a lot of transfer payments made to people, and that's kind of all ending right now. So is this a head fake with, rates floating up here towards the end of the year, or does this mean that, the economy really is going to catch a bid going into 2022?
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.